I'm looking at my wife's face going like, oh. All right. So the whole life debacle. So who knows this word? Debacle. Debacle. Fiasco is the one I picked. So the whole life thing is a big fiasco, right? So I call it the crusade is real. And I made this talk when I was in RTP, so it's right there. I'm going to skip this slide and go right into this. A.L. Williams founded our company in 1977. Why am I going back to this? I want you guys to really set the right expectation. That would make me so happy, you know.
Yeah, sorry to throw it, but that would have been good.
Everybody give your own big hand. Why am I going back to this?
Because you got to understand the reason that we're all here and why it started.
And why whole life
It's bad.
The Crusades.
is not that great.
Yeah.
See, I'm being polite about it, right? All right. So in 1977, and we're going to fast forward to 1992. I'm just going to warp you guys to 1992. And who has not heard of this document that you see on the screen right before you? Quite a few of you, okay? Guys, when you're in Primerica, your upline is not responsible for all your education. You're going to have to figure out some stuff on your own. And go look for stuff like this that lays your own foundation and for your belief system that when you sit across the table from someone and you know that you know that you know that whole life is bad, convince people. Well, how do you convince yourself first? By reading and educating yourself. Correct. So this committee had a hearing, and the committee was about, and then you see the date, right? June 23rd, 1992, and I found it in a library that submitted it into the library in 1993. So I was just browsing the internet for some good information that had nothing to do with Primerica, but everything to do with the industry that we're in. Asad Faraj always said, I hate the industry that I'm in, but I love the company that I'm associated with. Well, you can't make a statement like that unless you can back it up with some facts. So if somebody challenges you, then you can tell them, hey, I can back it up. They had a list of witnesses. What I really want to point out is this. This document is 317 pages. Yes, that's what I thought too. So I have to read this whole thing to really figure this whole thing out. So I read it. Now, a lot of you had heard about it, and a lot of you had not heard about it. But who actually read this document?
You.
I'm the only one? Right? So listen, you can't do that to yourself. You gotta commit and get all the information into you, because if you do that, literally, I don't think I can be in front of anyone that can convince me that what I'm about to discuss with you is good. There's just no way, because my foundation is solid. I'm rock solid on. Are you that rock solid? That is when you sit across the KT, or you're in an agent confrontation, and then all of a sudden you're worried about, wow, that guy's saying some really smart sounding stuff. But is he saying the truth? Is he saying some stuff that he's regurgitating? So don't be caught yourself into just regurgitating facts that you have picked up here. Get a good foundation. Does that make sense?
Yeah.
Right? This hearing will come to order, he said, and today's hearing is about how life insurance companies and their agents intentionally mislead consumers about how much their life insurance policies will cost and what those policies will be worth when they need them the most. What is that already implying if you just start reading that first sentence? To me, I was like, I gotta dive into this, right? Because I know it's gonna get better than that. So The second thing that I realized is, I'm reading through this whole document, I'm just gonna highlight a few pages, okay? Are there other specialty products on the market, this question was asked, right? On the market for which you feel illustration practices should be researched. What's an illustration?
Drawing.
What's an illustration in our industry, if we talk about an illustration?
Table.
Thank you. My wife? Guys,
Go Partners.
I'm talking about, I'm sitting here with people in 501. If someone talks about an illustration, what are they talking about? The tables that they provide you with, in which they do all their projections on how much. I'm super proud of you, babe. I'm gonna tell you that.
Didn't came across in the question mark behind my name, but okay.
No, what I'm saying, my wife is the only one. I'm super blown away. First to die, variable life, universal, registered life, variable life products, disability income, living benefits, term to 100, basically low premium whole life with non-forfeiture values, sold in Canada only, often assumes very high lapses in pricing and illustrations, annuities, lab supported illustrations, yes, UL and FUL products. What are those, guys? Some things down. Annuities, accelerated benefits, renewable health products, the list goes on and on, right? Universal life maturing as an annuity, interest sensitive whole life, group UL especially for executive purchases. These are things that these people that were questioned, and the people that were questioned were the people in the committee and a subcommittee and another subcommittee. You have to read the whole report. And the whole thing was, these are things that they are wondering about. These are things that they go like, maybe that should be looked into. This is back in 1992, correct. Another thing that popped out when I was reading this, surrender charges are another cost that companies try to hide. Surrender charges are what companies make, what company makes a consumer pay when the policy cashes in his policy, when the policyholder cashes in his policy during his early years. These charges are usually so high that most policies have absolutely no value until a consumer has paid premiums for at least 3 years. But most consumers don't realize that until it's too late and they get to get their money back, right? So, what is he saying here? Say it in your own words. What is he saying here? Anyone?
The policy is worth nothing for the first 3 years.
I was just about to say that.
You make Daddy proud.
You may end up owing the money.
Why am I asking you guys this question to say it in your own words? When you sit at the KT and they have this and they're trying to dig their heels in, you have to make one short statement that hits home right away, right? So how does Ian teach us this? Jerome?
So if I'm going through the whole life policy?
Yeah?
Yep, so Aristide, is it okay if I show you how your product works? Kind of give you a quick 2-minute education on
Yes, please.
Okay, awesome. Well, I don't need to be drawn. So it's kind
Okay.
of awkward not drawn. Can I come up there and draw it to you?
You don't have to draw it. You can sometimes. No, I don't like drawings.
You don't like drawings? Okay, awesome. So Aristide, so kind of give you an idea of how your policy works without
Yeah.
drawing it to you.
Okay.
So your premiums every month, they're paying for 2 things, okay?
Okay.
A portion of your premium is paying for the actual insurance.
Right.
Then the other portion of that premium is funding a separate account, okay? And your policy is set up to go till death or up until age 100. And that looks good. You feel like, hey
That's
man,
what I have.
yeah, I have insurance, I can save money, it also
Yeah.
lasts me forever. That's a good thing, huh?
That's what I want.
Actually, you have 4 major issues with your policy. And people that don't understand insurance, Aristide, these 4 issues are easy to miss, okay? The first problem is the cost. These are very expensive, okay? They're 3, 5, 10, 15 times the amount of return product which I already showed you, okay? The second problem is, Aristide, the first 3 to 4 years of having your product, this cash account has no money in it. Okay?
What do you mean?
So let me give you an example. Let's treat this like, let's say this is a bank, okay?
Okay.
Now, Aristide, if you were to save money into, where you bank at right now?
Chase.
Chase Bank. Okay, awesome.
Yeah.
So let's say you're saving money at Chase Bank,
Yeah.
and the teller says, "Hey, Aristide, you know you opened the account here. You're going to be saving money here. The next 3 to 4 years, Aristide, don't think about coming back to take any money out because there will be no money here." What would you tell that teller?
Dude, I would not open that account.
You would not open it.
Yeah.
Well, you just did. This is not a bank, but this is in your insurance. You just did. Okay.
Time. I called on Jerome. He didn't know I was going to call on him. But do you see he's ready?
Yeah.
Are you ready?
Yeah.
Are you as ready as Jerome? That's what you got to ask yourself. Give Jerome a hand. So, second part, most policies have a clause that allows the company, without telling the policyholder, to dip into savings component of the life insurance policy. This can happen, for instance, when a consumer stops paying on a policy because he or she believes that a policy is paid up. How often do you hear in the field, "Oh, I'm all paid up"?
Yeah.
That should be like, ding, 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 ding. This is what's happening. I need to do what?
Look at the policy.
Educate. Thank you. One of you. You need to educate. We're an education business, people. We need to educate the people that we sit with. We don't argue with them, we educate them. A lot of us when I hear stories back, they're arguing with the clients.
Yeah.
Stop arguing. Start asking questions. If you're asking questions, they start explaining to them and you go like, wow, so that is what they told you? You remember the "you have no life insurance" look? That's my same look that I give. So that's what they told you? And then you do the bank story. And then all of a sudden you're having a conversation. And if I'm sitting across from them, I said, grab your policy, and I relocate myself right next to them. What just happened in the body language atmosphere? We're buddies now. Let me come and educate you. Guys, it's little details, but those are the things that are going to make you win at the KT. All right? Then, without even telling the policyholder, the company can rate the savings. This is what it said, can rate the savings to pay itself more premium. We talk about this testimony we're going to hear. We're going to dive into that in a minute, okay? The next thing. Insurance companies have relied on thinly veiled disclaimers based on current assumptions. Current assumptions. So what they're giving you, those tables, those are not the facts. Those are
I would say something they hope happens.
best case scenarios that would happen when human lay eggs and birds have teeth. It's not going to happen. All right? Sorry, I had to come up with a good one. I had to say it nicely. I'm being recorded, right? Insurance companies claim that their cash value life products are a long-term solution to a long-term problem, and in actuality, they promote that. There you go. What do they mean with that? It means that they're setting themselves up that in about 7 to 8 years, they need to revisit that policy and actually say, hey, you know what? We got a better product now.
Yeah.
That's an old, it's like a car. You don't drive the same car for 30 years, do you?
No.
Don't you get a new car?
Yeah.
Yes. Let's get you into this new, better, and we'll upgrade you. And what did we just learn about a surrender value?
Super expensive early years.
It's super expensive, but we'll cut you a deal. We'll cut you a deal. You don't have to pay the whole surrender value. We'll absorb half of that cost for you, and they're still getting screwed into two. All right? So be careful for that. The systematic churning, it's called churning. You guys learned about that for your life insurance class. You guys remember that? The systematic churning is of the entire life insurance premium base every 7 to 8 years is a financial scandal and should never be tolerated in any other financial, it would never be tolerated in any other financial business. But somehow in our industry, it's okay.
It's wild.
So you have to be aware of it and say, hey, this is where I make a sad statement. I hate the industry that I'm in, but I love the company that I work with. Because this is how we got founded. And I share A.L. Williams' story. Right? What is cool? Oh, the transition. Sorry.
Yeah, something else, Aristide.
Sorry. I reviewed the annual reports of 20, so this guy went to work, right? And he was asked to do this work. I reviewed the annual reports of 20 of the largest insurance companies selected at random, right? It's not a setup. From the files. My focus was on Schedule M. Who has heard of Schedule M? No one. I didn't hear of it either, but I started to learn, right? My focus was on Schedule M and what's referred to as the interrogatories. So what are interrogatories? No, not questions. Interrogatories ask the question whether the insurance companies believe they can meet the projected dividend and projected interest rate assumptions for at least the next
2 years.
not 30 years that the policy in place, not the rest. 2 years, guys, 2 years. In my limited unscientific sampling, 80% of the companies said they could not meet projections for the next 2 years. So this is where they can't lie. This is where they have to be truthful, right? When somebody audits you, if they catch you in a lie now, they're going to assume that everything you do is not good, and they stop you. They put you out of business. So they're truthful, and what did they say? 80% of the companies said they could not meet projections for the next 2 years. So right away, as you have this policy, it's already not going to perform. Can you wrap your head around that?
Wow.
It pissed me off,
Yeah.
right? All too often, I have found young families, for example, that were overloaded on exorbitant premiums because agents have been doing their job. So this one is upsetting for me because somebody who has been taught something wrong still believes they're doing the right thing, right? So segueing into this for a second. So let's say, Michael, I'm there with you and you're the client, and I learned that it was your brother that helped you with this policy. A little bit touchy. Can you feel it? So how do you solve that problem? Because you want to say this product really sucks. Glenn E.D.
So you say, you know, obviously your brother-in-law would never intentionally do anything that would harm you, right? But assume that you know, he went to school and he was taught something from the school, so he's only doing what he was taught. If he were to see what I'm showing you right now, I'm absolutely 100% certain he'd do the right thing and show you what you need to do.
That's a great way to solve that problem. Glenn E.D., you're right. Anyone else have one that they want to share with us? Because this is interactive class, right?
This is the one.
Speak up.
The one Prux says is, you know, I'm sure that, you know, that agent was probably do the best thing for you, the best product that they had available, but they didn't have access to it when you have something like that.
It's another really good one. Give her a hand, guys. Anyone else? No one else? I'll share my favorite. Michael, do you drive a car? Yes? Yes. Okay, Michael. So my things are always question based. You guys notice that? Michael, do you drive a car? Yes. Great, Michael. Hey, listen. If your brother sold you that car, and it turns out to be a lemon 4 weeks later, would you be upset at your brother? Or would you be upset at the company that actually sold you the car?
I'd be upset at him. You should know better. But no, the company that made the car.
Great. So do you mind if and then I go into, but at this point, brother's off the hook. Do you guys feel that?
Yeah.
And then you go into your, I'm not attacking your brother,
No defamation.
It's good.
right? So stay away from that.
Yeah.
So find a way that you're comfortable with. We heard 3 examples. Pick one and master it. And then master the other 2 as well. Because sometimes you'll have to go over it twice before it hits home. That makes sense?
Yeah.
In many instances, when they need cash, the policies are lapsed, and all or most of their funds are lost. Of course, agents and management walk away with their commissions and overrides. They're not worried if a policy lapses after a year or 2 years, right? They've been paid already. In many instances, consumers may be far better off to purchase term insurance to cover their death benefit until the industry rights itself. Purchasing a lottery ticket may provide better actuarial odds of receiving a living cash benefits, and we know how bad the odds are in the lottery, right? Dude, that line alone has saved me like 5 times. I go to this presentation, I know it's on slide number 14, because that's all I remember, and I go like, read this sentence out loud, and they read it out loud, I go like, wow. I said, do you buy lottery tickets? No, why not? Because I'm never gonna win. But you bought a policy.
And understanding actuary,
Yep,
like, it's real illustrations.
correct. This is not made up stuff. This is the actual stuff we're talking about, right? So a little bit of education, let them read it. I'm not the bad guy. I'm just bringing the information to you. I'm sharing. Isn't that good stuff?
Yeah, it's great.
All right. Next one is this one. I'm still on slide number 14. There we go. Replacement. Replacement is one of those most abusive practices in the industry. Many agents have grown rich from such activity. One company, they're going to mention us. There we are. We're mentioned twice in this report, guys. And twice, I'll get to it in a second. One company has taken the lead, has taken the all-time lead in this category, Primerica, or as was previously known, A.L. Williams Organization. By some estimates, almost 50% of its business has resulted from replacement. Amen. Right? It's going to get real funny in a minute. All right. In the states in which I'm currently licensed, the requirements are scant that would otherwise protect the consumer. No analysis of products or whatsoever is required prior to replacement. So he's complaining about the process of replacement. So what is replacement? And you really want to make sure that everybody understands what I'm talking about. David.
To replace one policy with another.
Okay, it's that simple. It's nothing magical, right? Is that good or bad?
It's the same company other than Primerica.
Is it good or bad?
It's good, but it's Primerica.
It's Primerica, it's good.
If it's not Primerica, it's bad.
It's a good thing.
It's good because we wouldn't be here if we couldn't do it.
No, there's no rule replacing a whole life policy with another whole life policy. So it's bad.
Oh,
Guys, my wife reads this stuff with me, I guess.
No, common sense.
You can only convert it to a permanent,
Well, it,
for replacement.
In our minds, it's great because we're talking Primerica.
right?
right? Is it legal?
Yes.
Yes.
No.
No.
Replacement's not legal.
No. If you're doing it just to replace,
Oh, yeah.
Oh, you have to give them a better product.
So convert.
what do we have to do when we replace? What? You have to what?
Notify.
You have to notify, right? And he's complaining here, the agent replacement process simply has a consumer sign a form. This is then supposed to be submitted with the consumer's application for insurance. The carrier to which application for which coverage is being made is then supposed to forward the notification form to the company whose coverage is being replaced. In this manner, the company being replaced should be notified. However, in many cases, this either does not take place or the notice is received after the fact. So this became illegal back when there was a lot of legal battle between AL and the whole rest of the industry. So they made all these rules and regulations making it illegal. if you're just replacing to replace. However, this is why we educate. If you educate someone, it says, which one would you rather have? Am I replacing or having them pick? And there it is. And that's the solution to it. Right? You gotta know these little details so you're not doing it wrong in the field. Alright?
That's good.
The introduction of UL products in the early 80s brought about the replacement of many permanent or traditional whole life products. These were promoted on the basis of high gross interest rates and flexibility. So is he talking about Primerica now?
No.
Why not? Easy, right? So he's complaining about A.L. Williams, but then he identifies who does it the most and the worst, and who is it? The rest. Other 981 companies, right?
Yep.
I thought this was gonna get real funny. Check this out. A.L. Williams, I wanted to point it out. So I was reading this stuff. This is about a year ago when this happened. So can you guys see that?
No.
So I got really excited about it. Like, wow, this is a gem, right? So I text my big buddy, Josh Christian, and I sent him just that page, and he reads it, and I say, this is from a Senate committee report. Funny thing is, while he does not like Primerica, he's bashing his own company for doing the same thing, replacing, LOL. And agreeing down further on the next page, not sent, so we'll show you that page, that these replace policies should not have been written the way they were to begin with. In other words, replace them, just not by the termites. The termites, you guys, who doesn't know what I
Schecter mites?
what came there? Termites, who are the termites? Thank you. I like that you guys say us, so you guys own it now. He goes, where did you dig this up? I said, this stuff reads like an Alistair McLean plot. 200 plus pages. What year is this? I had to dig deep on the interwebs in 1992. That's what we call the internet at home, right? So, this is the next page I was referring to. The introduction of UL products in the early 80s, right? Here, the next line. My New York Life general manager, it's right in there, guys. I'm not saying it, the report is saying it. I'm not bashing, I'm just pointing it out. My New York, so what do I do when I have, if I were to run a New York Life policy? And I'm feeling a little bit of opposition on this. I say, hey, let me just share this information with you.
All right.
Guess which page this is? I know, 60. Right? I just remember those little details so I can pull it up, I'll get it fast. My New York Life general manager at the time solicited on several occasions that all policies to be replaced with UL. Blanket statement. Whatever we have, go churn it. The manager. Needless to say, the companies who were able to rid themselves of many products that had been growing for consumers based on reasonable rates of return. This practice within a company is referred to as internal replacement. It's still churning, guys. It's still not healthy. And the sad thing was, in the beginning, the really old policies, and sometimes you run across them, they actually were getting 7 and 8% versus the 1.44 on general that I see today. Right? They were actually getting somewhere with it, but those were all replaced. We got something better. Yeah.
They were getting 7 or 8% at a time when you could get 12 or 13% in the bank.
Correct. Now many agents are replacing their failing UL products, so this is on top of it, right? With high-flying term-based blended products. That term alone was like high-flying. All right. The agent, manager, and company all win, while the consumer again loses. Joseph Bell states, be wary if someone suggests abandoning one company for another. I'm in total agreement, as each sale generates new acquisition costs, commissions, and overrides. And I agree with that statement. I'm not saying this guy is totally full of it, right? If you replace something, it actually costs your client more. If you have a mortgage on your home right now, and you refinance it, what do you have? Finance costs, right? And if you do that too many times, the deal that you think you're getting actually costs you more. You'll end up paying way much more. So when you refi, your life insurance product, you have to be aware that there's a cost to it. But if the cost is $600 a month and you get one of the two, and you give them term, buy term and invest the difference, it's so big that you don't even have to calculate it.
Yeah.
You know you're gonna win for your client, right? The general manager, it just blew me away. Going to the next one. Here's A.L. Williams' second notice, I just had to point it out, right? It should not be assumed that only A.L. Williams agents replace trash value life insurance. He himself calls it trash value. I'm excited about that. While this company surely did more damage than any other life insurance agents for all companies, got on the bandwagon. Today, virtually every company has a means of accommodating rollovers of other companies' surrendered values, right? They all do it, and we do it too, except for we make a difference when we do it. They do it knowing that in 8 years, it's an 8-year cycle, 7 to 8 years, they'll do it again. They'll come up with something else new. When I started in Primerica 4 years ago, I was being taught whole life, cash value, and universal life. Now I run into all kinds of other stuff. Flexible universal term based on an UL chassis. I'm like, what? They make up new names for the same stuff. All right? The surrender value, this is what you really have to understand. When you fight with your clients, don't fight with them, let them read this. The surrender value is your equity, and most of these policies are sold to people as a savings or an investment tool. But your equity, so how, you guys understand how equity works, right? When you have equity in your home, you're not saving, it's actually based on what market is doing, it's gaining value. Not because you put money into it, which is what it is right now for most whole life policies. They're putting money into it and that grows the cash value instead of the interest rate growing it. It's a big difference. That's how equity grows. Money having the right interest rate will grow. That will give you equity, right? So cash value when they surrender is extremely important. Well, let me get this straight, right? In the 5 illustrations that we have looked at, we're a little deeper down in the report, right? We have not been able to determine commissions, the cost of the death benefit, the cash value, which will build up on the policy, expenses, and the surrender cost. That's 5 separate things we can't find out. Across the board in all these policies that they were asked to look at, they could not find the 5 things that you would think you would want to know when you have one of those policies.
Yeah.
Would you guys agree with that?
Yes.
You don't know your death benefit? That's a problem, right?
Yeah.
If husband passes and you cannot prove how much you are due,
Right.
I would say that's a problem. And that's just one of the problems, right? I don't see, he says, how anyone can be expected to compare life insurance policies and comparison shop if they can't even determine the actual cost of the death benefit in a single policy. This is why our job is so hard. And this is why you guys gotta double down and take the time to read stuff like this and defend and say, you know what, I wish I could tell you what your death benefit really would be. But you know what? I can't. But they can't either. If we would call your company right now and ask them these questions, and then when they answer the questions, I'll ask a couple more questions. You will see at the end of that call, they will admit, because I tell them I'm recording this call, by the way, so they have to be truthful, right? And guess what? They will say, they'll give me like 3 or 4 managers up, and at the end of the end result of that call will say, well, we'll send you a letter. And then we make the call, and guess what happens? If you do that with a client, you'll get many great referrals because of it. and you don't have to do that with the rest of the referrals you get from it. Does that make sense? All right. This one blew me away. It's just right there in the report. Anyone who understood the business and every actuary who worked in life insurance in those days knew that the professed high interest rate advantages of your policies were what? Phony. You're sitting with people right now that will defend tooth and nail their own policies. Don't argue with them. Just say, hey, you know what? I read a report. If you really want to, let's go read a couple of these pages together. And then you tell me if you still feel the same way as you feel right now after we've done a little bit of our research together. Do you mind if you spend 10 to 15 minutes doing some research? Because what if I'm right and what if you're wrong? Is it possible? And then if they want to argue, I ask them, so hey, Dakota, is Pluto a planet or is it a asteroid?
Depends on who you ask.
All right, so older folks will say what?
Planet.
And the new kids will say what?
Took the war.
So if I ask their kids, I said, wait, we're talking about the same Pluto, right? Not the dog, that thing in the sky that you can't see unless we... Guys, it's what you have been taught. And that's what I tell the people. You've been taught something, but is it possible that you've been taught something wrong?
Yeah.
So let's go find some facts. Right? All right. Then they have these things in the same report. It just blew me away. I'm gonna zoom in, okay? They're comparing, I'm gonna zoom in, you'll see it better. They're comparing cash surrender value versus by term and invested different. What a concept! So if you would do this or by term and invested difference, which one of the two would be better?
Is this by the same agency, the same New York Life guy?
This is the
different person?
same report.
This is
No.
a report
No, I was.
filed together by a committee who was investigating the life insurance
Yeah, it was a.
industry.
It's like there was a New York Life guy talking before.
Right, so
But now
this
it's
is a
somebody-
different,
Okay.
these are, they asked 15 companies to give these tables.
No, it's fine.
And they said, let's use the table that they provide us, and let's compare them to, if you would not do that, not invest in the product, but you just buy the cheapest possible way of getting life insurance, which is, thank you, and then invest the difference. What a concept. So you see the two side by side, right? So let's go look at the first one. The first 5 years, negative 5.7, 6%, 7.987. Not bad, right? But look on the right side. In the beginning, we don't report the invested difference because the amounts are so small. But after the 6th through the 10th year, 11%, 11 through 15, 10.4, 16 through 20, 10.5. Which one did better? I'm gonna go back one slide. This was a non-smoker age 39 for a $500,000 policy. You guys see that at the top? All right. Going forward. This is the next one. This was a 34-year-old, 650. First 5 years, minus 11, 3.7, 6.7, 7.7. You guys see that? Oh, I forgot to mention the other good stuff. 9.8, 9.7, 9.6. And remember, guys, here you get one of two. And here you get both. So that alone is a win, right? And your money is not making money. And it doesn't even matter if your money is making money, because why? You're not gonna get it. And they say that in the and actually we're doing this, but it doesn't even matter because this money will never be received by who? The consumer. Yes. This is the last one, right? So this was on Why is it minus 100%? Let's look at what this policy
Whoa.
is
Oh,
on.
first one,
6 years.
Wow.
Wow. Is that possible? Wow.
Look at what they're paying. This is a 65-year-old, a 65-year-old, 500,000 policy. What is this guy paying a month? You guys see it up there? $34,000 a year. A year. This is inlay.
So 25 grand, 2,700?
Just a hair under 3 grand.
Right? So this guy had money and was talking to a whole life product, and he would have done way better if he would have just, what's that? $2.5 million. I apologize, $2.5 million.
That's what I was.
But still, it's a big chunk of money, right?
Yeah.
Man, if I were 65 and doing this, I would see this guy coming and I literally, he'd go home limping because he would have no kneecaps left. All right? We're leaving 1992 and we're going to 1993. Right? So there's a hearing in the Senate. Man, I'm already running out of time. This is awesome. There's a hearing in the Senate that actually discusses now a year later the same report. Right? The Federal Trade Commission issued a 2-volume report. What does it say? In 1979. When did A.L. Williams start?
77.
Right? So in 1979, they already were criticizing sales practices in the life. In short, the 1992 hearing was not even the original. So get this, guys. 1979, crap happens. They investigate it, and then what happened? Nothing happened. Now we're in 1992. Crap has happened. They found out, and now they're going to discuss it. And when you read this one, guys, go online. Go online. Oh, it's on that side, of course. Go online. You'll find this report, archive.org, stream, blah, blah, blah. I'll share the link if you guys want to. You'll find this report. And he says, almost 1 year ago, I chaired a hearing, right, in this courtroom, looking at sales practice in the life insurance industry. It was not even network news. It did not make a broadcast by C-SPAN. Put bluntly, it was pretty dull. Well, he calls it pretty dull. I call it wow, right? And that hearing explored a question that has been around for a long time. Do buyers of life insurance understand what they're being sold? No. But if you don't know how to help them, because your foundation is not solid on this is not good, that's where it goes wrong when you sit at a KT and you don't know what you don't know yet. Go educate yourself. This is actually my class, what it's about today. That you need to educate yourself on what you don't know yet, so that when you sit with them, it doesn't become an argument and someone who can try and maybe sound smart and tell you some stuff that you realize, hey, I just don't know enough to argue back with you. Because you don't want to argue. When someone says what to you in an objection, you generally start to do what? You start to laugh because you've heard it before, right? Because if they're saying stuff to you that you haven't heard before, now all of a sudden they conceive that as they're winning and you're losing. Do you want to be sitting like that at the KT? No. So what is it going to take? You educating yourself.
Right.
All right? I'm going to go back to my presentation. So we're leaving 1992, I said, right? 1993. Yeah, I added that in. So this is what I found right before I got sick. A policy, this guy was paying $14.81 a month, $250. So $14.81 a year for the face amount of $250, and the guy was 33. No, he was.
That's policy.
This is policy year. He was 50 in his 50s, right? And what happened? happens after year 15? It decreases. He pays the same amount, but it decreases. So at initial look, I thought, hey, wow, that's actually a great rate. Not only is it a great rate, it does exactly what we do, doesn't it? It's just going to do what we do. So I thought, man, there's other companies out there that are starting to copy what we do. It's going to be harder for me to run my business. That was the thought that went through my head, right? You see it, right?
Yeah.
And then I flipped the next page. I said, what is this? There it was. That's the first page. And what does it say there?
Flexible.
I'm like, wait, it's flexible, it's universal life.
No bueno.
What is it? Right? Then I started looking at more details. I read, so your initial face amount is 250,000, but the minimum face amount is 100,000. All right, which one do you have? If you die, what is your spouse going to get? I asked them.
The minimum. The minimum.
He didn't know. But he was told what? It was term. Okay. But if it's term, this is what I found in the policy. You guys ready? Dividends?
Nope, not term.
Not term, right? We all know this. Cash value tables?
Not in term.
Minimum face amount? Not in term, right? Rules about what would happen if he's late with a payment. What would happen with the cash value? But wait. There's cash value buildup. Clearly states in the policy there's cash value buildup, but he has no access to it. So, there was only one solution. We called. Right? We called. Right? So we called, and I called this agent first, and he said, oh no, it's term. Okay, let's meet and discuss with the client. And when we were there, we called Protective, the company, and they called it what? It's a term policy on top of a stripped down dual chassis.
I was going to say that, so stripped out you will.
And I said, wait a minute. If I buy a car and it has a Volkswagen emblem on the front of the hood, but the manual says Pinto, which one is it?
Drive like that.
This was me. I'm like, what? I was going through all these three at the same time. I was completely flabbergasted. I just couldn't figure it out. Needless to say, we replaced it, right? So we're leaving 2014. And who's that? All right. We may not or may like him. I don't care. But you know what? What I do like about him is this. What does he say? Works and Teachings by Larry Burkett, Ron Blue, and Art Williams of A.L. Williams Company, now called Primerica. He developed a simple set of lessons and materials based partially on his own experience and on works of those people. Hey, I'm cool with that. Then something happened that blew me away. You know what's going to come? You don't know what's going to come, but you're in here. This is your wall.
Oh, yes.
Do you remember this?
Yep, I remember.
All right. So, Jay, I should have, I guess not put his name out there. Guys, don't go broadcast
It's not
this,
his real
okay?
name anyway.
Okay, good. Right? He was all upset that she was telling him that five-term invested difference is better than the product that he was trying to defend. So why don't you, he goes, why don't you show me an illustration of premium for a person that wants to keep their term life after coverage is up and they find themselves no longer insurable? Which theoretically, normally, if you buy a term anywhere else but Primerica, that would be the case, except for in Primerica. You guys with me?
Yeah.
All right. So this is how that works, right? For those of you that still don't understand it, that benefit after 30 years, it would stop, and he is right. But what do we do in Primerica? Increasing term between 30 and 60%, all the way down to age 100.
Is that what you tell people when you sit with them, is the 30 to 60%? Cause doing the math, it's, so I'm just
Depends
curious
on who I sit
What
with.
does everybody really say though?
It's a great
You
question.
gotta frame it.
You gotta frame it.
Yeah.
If you're sitting with a very young person, it's way higher. If you sit with a very older couple, that's with an older couple, and they're a little up there, it goes down to as low as the lowest I've seen, I think, is 14%. Yeah, it all depends, right? But in general, somewhere between 30 to 60%. But whoever I sit with, I frame it. Right? Great question. And this blue line represents what? Infest the difference, right? So at one point, to defend what we're all doing, if you're doing it right, you teach him to infest the difference, and because you teach him to infest the difference, what happens? They don't need life insurance anymore, right? So, he was complaining, and this is what he gave up as an example. And then I'm pointing a couple things out. They're talking about the value in the next text, and they're talking about the growth of the cash value, right? It grows. So he's happy. He sees growth, right? So Regina says to him, if you're paying for a death benefit and cash value, which every cash value policy says you're buying and are sold that way, you should always get both. Option A only gives you one. The cash value is only an illusion. When you buy term, invest the difference, and die, your family does get both, right? So he goes on, getting both has its cost. Plan A will obviously blah 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 blah. Will cost less, blah blah blah. He goes on. Going back in the one I showed you for a kid, hold on, it's a great savings tool for the future. It should allow, it allows a build-up for cash a child can use tax-free while keeping them qualified for tax credits and doesn't count against them when applying for FAFSA. They're also not penalized if they choose to use this investment for purposes other than college. So it's a great tool.
If they really believe that.
It sounds good, right? If you read it like that.
I sat down with this man before we did this, we sat down with him.
All right.
Remember this?
So then comes in our buddy
Was
Carl
it in?
Carson. Check what Carl Carson wrote. And this is, guys, you should take a picture of this and memorize this word for word. What does he say? Cash value is not tax-free, and it's also not a tax benefit. Any growth over the cost basis is taxed at ordinary income. The reason you've been misled to believe it's tax-free is because, as you see in your very own illustration, in 40 years that the policy will have the cost decline 24,000, and they only have 10,000 in cash value. They could have saved 600 a year in a coffee can and had over twice the amount of money. No interest. They would have had twice. This is also the, I know, right?
Yes.
This is also the reason it keeps them qualified for tax credit or doesn't cost them against FAFSA. It's less than they put into the policy. You don't lose benefits when you have no benefits, right? Client would be far better off buying term investing, perhaps investing in a muni bond fund, which actually grows above that what you put in and actually is federally tax-free. What does Kyle say?
You're right.
You're right. I apologize.
I was just like,
So this is and I thought, so this is done. But it's not done until the bad thing things. So in this case,
20 minutes later, like.
yep, he's like, boom, boom, boom.
Yeah.
Guess what? He owns it. Do you own it?
He had nothing to say.
Right? So this is Ian. Say, you stated that UL makes more money the first year. But that's false according to the table you show here, where the surrender value is 0. And also you're selling 126K of life insurance to a 3-year-old for $600 a year. Nice. Josh is going, nice job, Ian. There it is, right? This is going back to his table. It's making money. It's not making money. H3. So, and this happens within minutes right in front of our eyes. And at this point, I'm like, I gotta do the Carlson. Guys. We're in recruiting frenzy right now, right? We gotta hit how many?
400.
Are any of you doubting we're gonna make it?
No, not at all.
In 501, I expect everyone to chime in on this one, that here is where it's gonna happen. Right? Ian is gonna call me tonight and he's gonna ask me how did this class go. And I wanna report back to him that everybody here agrees that this is where it's going to happen.
Yeah.
Who's not gonna recruit at least one person this month? Look at those hands go
before
up.
the meeting.
What's that?
Just count one before the meeting.
Let me make that. Guys, I didn't go through any policies. We can do that the next time. But I really wanted to lay a good foundation for you guys to realize, crap, I need to go learn a lot more so I can be way more effective at the kitchen table than I am right now.
How can we get a,
what was that you
that
actually?
whole document?
So
Access
if
to
I
the
can
whole
find it, I'll share it.
Can we get it on?
Guys, nobody told me, Ian didn't come tell me, go figure this out. Nobody told me. But I wanted to know, right? Because if I'm gonna sign a client over from something that they have to this, I have to be 100% sure that I'm not lying to them, that I know what I'm talking about, and that I feel confident that when I tell them something, that it's actually backed up by facts.
I'm just curious.
What's the name of the document?
Was there an outcome to the hearing? Like, what did they?
I missed that part. In 1993, about 2.5 months later, they actually passed a law in Congress that this was never to be discussed in Congress again. Take that.
And it passed.
And it passed.
Meaning the president's.
But what you talked about was good though, bro. You
Guys,
Who's president?
us as agents, we gotta skill up because we walk away from the table when we see stuff like this and we don't.
because we're not skilled.
Yep.
Right.
And people are getting screwed, dude. And we don't know what to say. We think it's okay. It looks all right, right?
It doesn't look all right.
Yeah.
They already have a policy. It's the biggest lie I've ever heard. Even if they have a Primerica policy, it's the biggest lie. You know why? Because the agent that actually helped them with that policy might have not been educated enough to get them what they really needed.
And
Did they do an FNA? No.
And consumers are becoming aware of this, dude. I said my clothes today, the lady specific, out of her mouth said, Jerome, I don't think my grandkids should have, what's up with this Gerber Life and Global Life stuff on kids? It doesn't seem right to me, literally out of her mouth. I said, we're on the same page, let me show you why. People are not, they're catching on to this crap. It's not the best.
One of the biggest things that I hear out there, and you will hear it too if you haven't heard it yet, is that they say, what do the Primericans know? Because they're only part-timers, most of them, right?
Yeah.
Who has not heard that before? You will. You will. And guys, at that point, if you know this stuff, you say, I may be part-time, but I'm well read in the material. And let me show you why. And then you start pulling up this stuff. Discussion is over.
Boom. Yeah. Wow.
All right?
I just want to say thank you for showing us that.
Yes.
I had no idea.